Imagine walking into a bank. You hand them $100. You expect that $100 to sit there, safe, untouched. But here's the twist. That $100 doesn't just sit there. It becomes $1,000 or $10,000 overnight, and almost nobody knows how. Money isn't what you think it is. Banks don't just store it, they create it out of thin air. And the system depends on most people never questioning it. You've seen the headlines. Inflation surges, housing prices explode, markets swing wildly. People blame governments, corporations, even each other. But the real engine behind it? The invisible money banks create. Understanding this isn't just for economists. It affects your mortgage, your savings, your investments, your entire financial life. Here's the basic idea. You deposit $100 in a bank. Seems simple, right? But the bank doesn't just tuck it away. They lend most of it out, say $90, to someone else. Now, here's the kicker. That $90 loan becomes a deposit in another bank. That bank can lend most of it again. This happens over and over. Mathematically, a single $100 deposit can generate hundreds, sometimes thousands, in new money circulating in the economy. This is called fractional reserve banking. Irony check. Your money is technically still yours, but simultaneously it's someone else's too. Let's put some numbers on it. A $1,000 deposit with a 10% reserve requirement can theoretically produce $10,000 in the economy. And that's not an exaggeration. It's not printed cash. It's digital entries, numbers on screens, created by promises to pay, by trust, and by laws that let banks lend multiples of what they actually hold. The absurdity. Most people think money is finite, but in this system, money can appear or vanish almost instantly. You've heard politicians say, "We're printing money." But central banks printing currency is only a fraction of the story. The majority of new money never leaves the banking system. It's digital, invisible, yet it drives asset prices, inflation, and debt bubbles. Reality check. The money supply you read about isn't literal coins or notes. It's promises layered on promises, a system balanced on trust and regulation. This has enormous consequences. Boom and bust cycles, housing crises, student debt, inequality. All of it is amplified by how banks create money. Every dollar you borrow, invest, or save is entangled in a web of digital creation. The more the system expands, the more fragile it becomes. It also explains why financial crashes feel sudden but are decades in the making. The mechanisms are invisible, but the effects are brutally real. So, next time you think about money, remember, most of it doesn't exist in the way you imagine. Banks can create it, shift it, and multiply it all on paper. The uncomfortable question, if this is how the system really works, who really controls the flow of money, and what happens if they stop playing by the rules? And the answer isn't as simple as you think.